So this is the first half of our Capital Markets Day. Many thanks to our speakers, to Aziz, to Rene, Fatima, Saim, Nigel, and Bilal. And we have two Q&A sessions scheduled. The first one is going to focus on our strategy. So you can ask your questions now. You can type them in the Q&A function, or you can just raise your hand in Zoom, and then we're going to open up your phone. We're going to keep the questions on the OpCos, on Qatar, Iraq, and Indonesia, and on finance for the second Q&A, which should start around 2:15 this afternoon. But let's focus on the strategy and the equity part in the first half. So let's see what questions we have. So there's one question here from Omar Maha from EFG. Thanks for the question. Thank you for the great insights. One question on the 20,000 tower carve out. Will this be done in one go, listing as a single entity, or would you be willing to sell off parts separately if you get good offers from tower cos in different regions? Aziz, you want to cover this one?
As explained, first of all, as a process, we're currently creating independent tower cos in every single country we operate in to hold the towers of each of these opcos, and this is a regulatory obligation. We also are establishing a holdco tower co, which will own ultimately these independent tower cos. Whether they own a controlling stake or a minority stake, this is still to be determined depending on the technical skills and also the valuation we get for each and independent countries, but also it will depend on whether we select one single operator to go alongside us or multiple operators depending on the country. There are two clear variables for our selection here. One is value, but more importantly, even if these are passive assets, these are the assets that hold our active assets. And we need people on the ground which are able to operate these assets effectively, but also deliver on the operational benefits. As mentioned, we're going through all the reviews right now to see what will create the maximum value for the group, for our opcos, but also our shareholders.
Very good. Thank you very much. Then we have a question from Manjun Tan from Eastspring. Impressed with the plan on value crystallization. Is there a timeline for the tower and data center carve out? And what's going to be the impact on future dividends?
So in terms of timeline, as mentioned, we're targeting to finalize the carve out of TowerCo and data center, hopefully within 2023. Timelines are a bit elastic and unpredictable because these require regulatory approvals in every single of the countries we operate. And as you know, some of these countries don't have fully established regulation as of today. So we're hoping and pushing very hard and working towards a close towards the end of 2023. But again, we might slip going forward. In terms of use of proceeds, and you've heard me say this before, we usually will try and dividend out to our shareholders any additional free cash flows we're generating from operations. When it comes to monetizing assets, technically you look at the TowerCo, for instance, it is a sale and leaseback. It is a better use of our proceeds if we're able to reinvest this capital in higher growth opportunities, which have a higher rate of return than the lease we're going to pay on the back of these assets.
Great, thank you very much. Then we got a question here from Nishit Takihota. Goes a bit into the finance area, but maybe you can take this one already. Regarding the portfolio optimization and the Myanmar exit as part of the strategy, what is the approximate likely impact of the $162 million exit from Myanmar on the profit and loss, assuming the deal is executed as intended in Q4?
The impact on the P&L is hard to say as of today. As you know, we've taken nearly a total write-off last year for the value of the asset. The impact will depend on the timing of the closing, as we have to sustain the operation till now. We're hoping to close, as mentioned, in Q4 of this year. But as also as stated, this is an ambitious timeline and might slip to 2023.
Thank you very much. Just as a reminder, you also can ask verbal audio questions. If you just raise your hand in the webinar here, then we can open up your microphone. And there's a question from Mehdi Singh from HSBC on mobile money. During the presentation on slide 7, fintech data was a bit confusing. Can you please explain the difference in the two charts on the left? We're going to get back to that. We're going to get the slide ready and definitely answer that question. In the meantime, there's a question, are there any plans to exit any of the existing operations that are not first or second operator within their countries?
No, so no, we're not planning to exit any further operation. We believe we have a strong path to being a number 2, number 1 operation in the medium run in all markets where we're currently not. So we think in terms of a portfolio rationalization, we finalized the exercise as of today. Of course, it's a constant review.
Excellent. Then there's a follow-up question on Myanmar. Any further impairments or currency losses expected for the later part of the year?
As of today, we don't expect any. Again, it's hard to crystallize that value till we know when we're going to close this transaction. So we'll come back to the market upon closing of the transaction with crystallization of value or losses at that point of time. As of today, none are expected.
Excellent, very clear. So now we're going to go into the mobile money question. And okay, René, that's a question for you.
Okay, thank you, Andreas. So what we see here is basically we cut the data according to that GSMA study to kind of give you an idea on market shares. GSMA basically has here under mobile money, for example, peer-to-peer transaction in the same market, or if you pay with mobile money, for example, through barcodes at the point of sale. This is captured in the upper part of the chart. This is where GSMA says we have about 13.7 billion, transaction value in the MENA region. We do in the MENA region roughly 5 billion. That equates to the 35% market share. In addition to this market, GSMA also provides data on the remittance market, in which we are also active. So the overall market by GSMA in this study, which is available publicly, is basically a global transaction value of roughly 16 billion. And we do about 2 billion, which equates to 12% market share. I hope that clarifies this part of the question. The second part relates to would we continue in Myanmar with mobile money? The mobile money operations are part of our sale in Myanmar. So with the conclusion of the sale, we would basically end our activities in mobile money in Myanmar. And as we pointed out, we're currently having roughly 400 plus thousand customers in Myanmar on mobile money, quite substantial, but also with lower transaction values. I hope that covers the question.
Very good, thank you very much. Then there's a question here from Ziad from Arkham. How should we think of the CapEx going forward with $1 billion USD to be spent on data centers alone and the 5-5-10 billion strategy is $5 billion US dollars CapEx in 3 years, implying a strong pickup? Aziz or Nigel, who wants to comment on this one?
So as explained, part of the rationale of setting the data center business as a separate entity is because it has a different cost of capital and a different capital structure. It's more of a real estate play, a technological savvy real estate play. When we say there's $1 billion of investment, that is not only equity. We believe that we can leverage that investment quite significantly versus traditional telco operation. Also, shareholders have, and including yourself, have often highlighted that our leverage ratio is too low. One of the ways we're going to address this is in these different business units is doing specific leverage for these businesses at different level. Once consolidated in the business, will increase our leverage.
Very good. Then we have a question it's more for the afternoon session on Qatar, the expected impact on the World Cup. I don't know if anybody wants to, or actually Nigel first on the CapEx.
Yeah, maybe just to finish off the answer on the CapEx. So 5,510 is CapEx, OpEx in total. And as I said, it was 2022 to 2025. So that's a 4-year number, not a 3-year number. And I think that makes quite a difference. There is no intention to drive major, additional incremental CapEx spends on the BAU business. We did speak about some opportunities in fiber and so on, which will be looked at, but everywhere we invest will be done on the basis of business cases that make sense and a very rigorous process around every dollar we spend. Thank you.
Thank you very much, Nigel. Yeah, the World Cup question, something for this afternoon, or do we want to give an initial comment on the impact of the World Cup on our business?
I think we have a specific section for the presentation of Qatar and Indonesia on these, so we'll answer those later.
Great. And the same goes for the finance question. How can we analyze the earnings in first half of the full year and what's the outlook for 2023? So we're also going to park this finance question and cover it later. Then there's a question on mobile money customers growth excluding Myanmar. Renee, do you have any comments on the question from Ziad Itani there?
To go back to the customer data on Myanmar, we have basically achieved a growth of the customer base in Myanmar, which was quite substantial, of 430,000 customers over a year. So if we basically minus this off, you basically get from there the normalized growth. Again, we are very well entrenched with a high market share in Qatar, which is in that case a very mature market. And as we said, we will look at selected other markets where we see massive growth opportunities with the new launches that we intend to do in Q1 and Q2 next year.
Great. Thank you very much. Let's try an audio question for a change. And I'm going to open up the microphone for Mehdi Singh from HSBC. Mehdi, can you hear us?
Yes, hi. Can you hear me?
Yes, we can hear you.
Great. Thanks a lot for organizing the event. It was very, very helpful. I found a couple of things very interesting there. Firstly, your slide on the differentiated services for different, let's say, ARPU levels of customers, probably that's the best way to put it. Are you in effect saying that net neutrality is practically going to not exist? You will have this model where, anybody who is paying more should deserve basically better quality of service across the board, across your markets. Is there any regulatory issues you're going to face in implementing this, if at all? And then second question is on the 5G strategy. Again, very interesting. Just want to understand, is your strategy is standalone 5G strategy, or you are going to do more and like a mix strategy there? And what are the plans regarding your spectrum utilization for 5G? Would you be reforming any of the spectrum for 5G, especially the low band spectrum? Is that something which is feasible for 5G repurposes? So if you could talk about these two things, and then I have more questions. I will come back to them if I have more time.
Let's start with this one. Yeah, so the first question asked was, how do we combine the concept of net neutrality and different categories, classes for customers? Nigel made that reference with the airline customers in economy, business, and first class. Do you want to comment on this one, Nigel?
Sure. Thanks, Andreas. So great question. As I said, we want to have a differentiated customer experience when our networks are loaded and busy. It's inevitable that at certain peak times of the day, we do have networks that are busy, and we want to provide a better experience to those customers who pay more. When the networks are relatively empty, we will allow customers to consume all of the services that we can offer. So we will be very selective in how we do this, and we will be very, conscious to allow customers to get access to the best services whenever possible. But there will be some differentiation at busy hour on the network.
Maybe one additional point on this. Net neutrality is on the basis of all services accessible through the internet to be neutral to each other. It's not a differentiation of speed of access for each customer. This already exists in every single market. So you can pay more to get 5G versus 4G versus 3G. Net neutrality is the basis of differentiation, of no differentiation, whether you're accessing YouTube, Netflix, or professional service. This we will not touch. Is the general quality of service depending on peak loads and your pricing.
Excellent. Then there was a second question from Mehdi asking about our 5G strategy, standalone. Do we need any more spectrum? I think that's for Nigel again. Or
yeah, happy to answer. Yeah. So actually, we take a reasonably conservative approach to how we invest in 5G today. So we look to utilize our current spectrum bands initially to provide coverage. We call this, there's a capability called dynamic spectrum sharing. This allows us at a relatively low cost to cover large geographies with a low band spectrum. Then over time, as we see more devices, more users, more traffic, we can deploy these standalone high capacity, higher band 5G sites to carry that traffic as it grows. And this strategy allows us to invest effectively and get the best use out of our spectrum assets. You also asked about refarming. We've been refarming spectrum in our markets for years, from 2G to 3G to 4G. And of course, we will continue that into 5G. So that's just part of the kind of BAU and business as usual. Thank you.
Thanks a lot. Do I have time for more questions, or should I?
Yeah, go ahead.
Okay, great. So, just following up with the previous discussion, in terms of your 2G and 3G footprint, is there scope for 2G network or 3G network to be shut off in the next few years if you have more and more traffic moving to 4G and 5G? Would that be a feasible, option?
Yes, so absolutely. So what's actually happening today is we are squeezing the amount of spectrum that is utilized on our 2G and 3G networks. Because of the devices out there, what we see is actually 3G will be retired first. And we see that happening kind of over the next 24 to 36 months in our markets. Over time then, as 2G devices, particularly the IoT devices that are out there, are replaced, we will retire 2G next, and all of that spectrum then gets moved up to 4G and 5G. Thank you.
There's maybe one additional constraint there, is once again, we're a highly regulated industry. This is not moves we can do unilaterally. So this has to be done in coordination with the regulators of each and every single country. Discussions are already going on, depending on each country and the maturity of their markets as well. Talking about retiring 3G, we just launched 4G this year in Iraq. So this would probably be one of the markets with retired.
One more question from my side, and then I'll keep quiet. In terms of your footprint, already, you have done some great progress in Indonesia in terms of in-market consolidation. Are there any other markets where you see a scope for in-market consolidation, especially if I talk about Algeria? Is that something of an opportunity there? And also in terms of new market footprints, would there be any other market where you think it would make sense for you to expand into, especially in the your neighboring areas of Qatar, let's say?
So, as a rule of thumb, I think when it comes to deployment of capital, we will always prioritize in-market consolidation versus out-of-footprint expansion. the return for investments is multiples in market consolidation because we can actually extract significant network synergies and not just network distribution, etc. And you will hear that part of the story with Indonesia, which is a case study. In market consolidation is something extremely hard because it usually requires losing one operator in the markets, requires regulatory approvals, and regulators sometimes see this as a loss of competition. Nevertheless, it's something we will push in any market where we believe there is an opportunity for that. Right now, remains extremely unlikely. When it comes to out of footprint opportunities, we of course always keep our eyes open. We try to be extremely disciplined. Out of footprint synergies bring usually out of footprint acquisitions usually bring extremely low synergies. There's no network synergies. There's a bit of procurement synergies. And the only way we would look at it that really makes sense for us is it's actually if it builds on our platform, which is basically a customer aggregation with demographics that have the same components. So, or we can expand in mobile money, usually for vast services, same localization, providing the same services, etc. And also footprints that can be adjacent to ours and create benefits in terms of our other core businesses such as data centers. Today, we remain opportunistic. We keep our eyes open. We haven't seen anything arise that was of interest. As I said, we'll be extremely disciplined when it comes to any potential acquisition.
Thank you very much. This was very insightful. Thank you.
Thank you very much, Mehdi. We're going to have another audio question from Faisal Al-Sabi. I'm going to open up your microphone now.
Thank you, ladies and gentlemen. Yeah, good morning or good afternoon, everyone. Thank you, ladies and gentlemen. This is Faisal Al-Sabi from MBK Capital from Kuwait. I just would like to thank you so much for this outstanding opportunity to meet investors and sit down with us, discuss your strategies and your achievements, which we really appreciate. And we think that this would set a golden standard for other companies, be it in telecom space or other sectors. I just have one question, and it might be a bit of a generic sort of a question. With such a clear strategy and to give you the benefits, we've been seeing the turnaround in Ooredoo since the inflection point back in early 2021. As investors, we see business improving, etc. And with today's strategy being discussed on all pillars, all segments, be it HR point of view, be it on operations, business, etc. For us as investors, how should we think of how we can benefit from a monetary point of view? In other words, for an investor, a share price increase or a dividend is the return in addition to, let's say, a recovery in earnings. Putting all of those three items together, be it higher dividends, be it a share price increase, which is a function of improving operations, and higher dividends, how should we think about that going forward, given that there are investments planned, there are things going on, and there are values being unlocked? I know it's a bit generic, but a clear or let's say a concrete answer would be highly appreciated. And thank you all, and thank you, Abdulaziz, for the outstanding, I would say, the print that we've been seeing in Ooredoo.
So I don't know if you recall if it was my third or fourth slide, which was the comparison of where does Ooredoo stand in terms of performance relative to our peers and relative to the top 60 telcos players, and I ended up on where is our valuation. The big number you should remember is if you look at 2021, we're the third highest return for shareholders in terms of a telco out of the top 6. we're still valued as of today by shareholders at 4.7x, which put us at the bottom of the pile. We're around 49th, if I remember, if my memory serves me well. 49th out of 60 in terms of valuation. So we fundamentally believe, as we continue on this execution and we continue demonstrating to shareholders that we are focused on the core of our business, on the different pillars, but also on disciplined execution out of ancillary businesses, that we can generate shareholder value. And we hope that all the people listening and other investors believe in our story and reflects it into share price appreciation. As you know, shareholder return is also driven by dividends. We have a policy of dividend payout ratio, which we usually stick in. I can't really affirm any change in dividend without going to the board, as this is a shareholder matter and requires board approval. But as our net profit and our free cash flow evolves, normally a dividend should evolve in line.
Right, I hope that answers
All
your
right, yeah. Yes, actually it does, but what I mean, Abdulaziz, is that for quite some time, even if we look at how much the company is trading at in terms of EV to EBITDA, from a market perspective, the discount is a function of so many things versus other players, be it the high risk countries within the opcos, etc., or يعني, even prior, let's say, I wouldn't say misguidance as much as surprises, negative surprises that were disclosed to the market. يعني, and I believe, honestly, with all due honesty, that investors' confidence is picking up. However, the strategy in terms of unlocking values is quite clear. Nonetheless, in terms of dividends, as we can see, and let me add to what you've said, Ooredoo probably enjoys the best free cash flow yield within the whole regional space. And there is a huge gap between the existing dividend yield and the free cash flow yield, accounting for all investments. How should we think about that? And is paying dividends would be considered a priority versus investments, or would investments come first?
So I'll touch base first on this one part you said, is we operate in high-risk countries. I actually believe Ooredoo provides a compelling offering because we have a mixed portfolio. We do have higher risk but higher growth countries within our portfolio, namely Iraq, Algeria, Tunisia, and Palestine. But at the same time, we also have very low risks, whether in terms of currency or geopolitical risk, countries with slightly less growth. And that creates a stable portfolio, such as Qatar, Oman, Kuwait. The mix provides, we think, a very healthy platform between high growth with a bit more high risk, and medium to low growth, but with medium to low risk. And the combined shares, if you remember my slide, they're sort of split 50-50 in terms of revenue contribution, EBITDA contribution, and free cash flow contribution. When it comes to the dividend policy, as much as I know you're all looking for guidance here, and I would love to give some, we have a corporate governance, which is very important as well in our ESG. And this goes from us recommending to the board, and it's for the board with the representative elected by the shareholders, which will decide on our dividend policy. The only thing we can say is that we have a guidance of a 60% payout ratio, which we stick and we haven't changed to. As our profitability increase, just naturally, organically, the absolute value of the dividend will increase. Will there be further increase to that? I cannot opine on it because it's beyond anyone at this table decision. It's a board matter.
That is quite good. Thank you all. And thank you so much, Abdulaziz.
Thank you very much, Faisal, for the questions and also the positive feedback. We have a couple of questions for the other speakers as well. One for Simon with regards to the ERP implementation timelines and expected disruptions, and then one for Bilal with regards to the accounting of visitor and tourist SIM cards. Simon, do you want to start on the ERP implementation question?
Sure, let me do so. So the ERP implementation will go across three areas, which are finance, HR, and procurement. The implementation timelines is over the next 3 years. However, and that will also probably address your second questions about the disruptions, is that we are doing the implementation above waves. So we will have only few opcos to go live in the first year. So we will take the learnings from there, and then we will go into the second and third wave where we will have the other opcos to go live. Obviously, there will be always a business disruption once you are implementing a new ERP platform. However, we are considering this as a back office transformation, and hence the disruptions would be minimal, as we are also doing it on a staged and wave-based approach.
Great.
Thank you.
Thank you very much. How are we accounting for visitors and the SIM card registration?
Thank you for the question. The simple answer is yes, these are counted. We've got specific triggers which define whether a customer is active on our network or not. And if these SIMs are active on our network based on those triggers, then yes, they are counted in our base. I hope that clarifies.
Thank you very much, Bilal. And then we have a technology question with regards to the CapEx savings coming up. Can you please talk about areas of savings? Is the unit price savings or lower unit requirements impacting the spending?
I can take this one, as we also discussed this, about this in transformation. So we see three areas where we have achieved the CapEx savings. I mean, two of them you have already mentioned, which is about the pricing. So through our approach, we were able to combine the demands and then achieve synergies on the procurement side. So clearly we saw a unit price reduction. And then the second part, which is about the requirements. So we are applying so-called smart network planning tools and approaches, which we really allows us to optimize our requirements and hence have a more efficient use of the CapEx. And I would then add a third element to it, where we actually brought in the discipline of how we are spending the CapEx. So which means that we have brought in a methodology where every CapEx spent in the future will follow a very disciplined financial criteria about business cases, return on investments. And hence we have a very strict discipline follow-up on how we are spending the CapEx, how we are monetizing on it.
Excellent. Let's take another audio question from Vikram. Vikram, I'm going to open up your line. Vikram, can you unmute?
Yeah.
Go ahead, we can hear you.
Can you hear me?
Yeah.
Great. Thank you. Thank you, first of all, for a very comprehensive presentation. A question, you spoke a lot about customer experience, net promoter score, also implementing a lot of digital initiatives. My question here is, on the back of this, can you gain market share in Qatar and other regions? Or do you think many of your competitors are also doing pretty much the same thing? And maybe this is just a strategy to defend your market share in different opcos in different regions.
Bilal, that's a good question for you.
Yeah. Thank you for your question. I think there are multiple benefits coming out of our focus on customer experience. So I would say it drives churn reduction, it drives your ARPU, and yes, it also, since we are also using it as a differentiation criteria. So without talking of any specific markets, yes, it is also a driver of market share as well as revenue market share.
There is a benefit which is usually a bit counterintuitive, overseeing a good customer experience. It actually results over the long run in a cost reduction in terms of cost. One very simple point: as your call center calls drop, you can reduce the size of your call centers. This is a very binary outcome, but actually people usually equate customer experience enhancement to cost and increase. Actually, what we've seen across industries and in the telco space as well, good customer experience program actually in the medium run results lower operational costs as well.
Right. Another question from me. in terms of, it's very clear that now we are moving more into data verticals rather than expanding into rather than expanding geographically. So we've already seen STC in Saudi create, they spun off their ICT division. Should we expect any of your entities to be spun off, maybe the fintech division or the data center division, or even the towers? We're obviously speaking about creating a separate company where all these towers will be lodged. Are there any aspirations to create or spin off different verticals into separate companies over the medium term?
So, as explained in terms of towercos, data center, and over time in terms of fintech, yes, they will be created as standalone companies, so we can show to our shareholders the intrinsic value of the sum of the parts. Also, they operate on different cost of capital, and they'll all be at arm's length of each other. Will they be sold or fully monetized, or will we relinquish control or not? These are decisions we'll do in the future when we believe it's in the best interest of the shareholder, and we believe we've captured the maximum of the growth versus the monetization part. So creating standalone entities with arm's length business with the telcos, crystallizing the value of the core telco from a towerco, from a data center, from a fintech, and maybe other opportunities down the line is something we're embarked in. Fully monetizing them or disposing of them is something we haven't applied on as of today.
That's very clear. Thank you. Thanks a lot.
Thank you very much, Vikram. A follow-up question on the ERP systems for Zain. Does it impact our billing systems?
Yeah, happy to take this one. So the billing systems will not change as a result of the ERP implementation. So the billing systems will feed into the ERP, but they will remain as they are.
Great. Then I see that Ziad Itani from Arkham has raised his hand. So Ziad, we can take your question on audio.
Thank you, Andreas. And thank you very much for the presentation and the valuable insights provided. We just have one question on the fintech arm specifically being labeled as an Uber-like platform. Does this mean you're not going to engage in microfinancing activities and lending activities?
Renee, I think that's a good question for you, fintech.
So look, in our markets, even today, we have sort of micro lending activities. If you look, for example, at device financing and others. So we are not carrying, as we said initially, the balance sheet risk as of today, and we're not planning to do this in the future. We will integrate partners basically into that proposition, so it's for customers seamless. It will feel literally as one central hub that is easy to use and kind of participate in these services. So in essence, it's a partner-based model, as we said, very clearly. Uber for financial services. I hope we don't need to pay branding license fees to Uber for that, but it's sort of the idea behind it.
May I ask what's the reason? Specifically, you have very cheap cost of funding being based in Qatar as the holding entity and a very clean balance sheet. I mean, even if you want to expand in markets with relatively stable currencies, such as Iraq, for example, which is a very attractive market, it seems to be an opportunity. So what's the reason behind abstaining from this?
Look, everybody has to focus first, I think, very obviously on what he does best. So for us, it's basically aggregating these customers and providing a super attractive front end and a great customer experience. That's a turf that I think we will excel. The second piece is to us, also in these markets, there is a certain risk attached to these type of business models, right? You see, for example, currently on buy now, pay later with rise in interest rates, you have to be an expert in managing that balance sheet. And we are, as of now, a telco, and we are basically not a manager of this credit risk as of such. We feel that partners are way better positioned to actually manage this on the back end. And we're happy to partner with them.
All right, that's very clear. And also on the same topic, specifically if we isolate the Myanmar subscribers, growth seems to be very slow relatively, I mean, for this type of business at 6%. Or is the 455,000 was part of that was already included last year, or what specifically?
there's a part of this included in last year. And again, fast currently, the mobile money operations, the bulk of the value sits in Qatar, right? And we're trying to leverage the expertise we have built in Qatar as the leading player in the mobile money space in the market in Qatar across our footprint. Hence, fast, this is a growth area which we haven't explored to the full extent of what is possible, right? Fast, let's say Myanmar only contributes a small, I wouldn't say insubstantial, but a small portion of the transaction values or even of the remittance value. So as of such, the, how do you say, the consolidation of Myanmar is no concern as of now. We still have, even after the consolidation, a super attractive mobile money business.
All right, thank you.
Thank you, Ziad. Actually, we had a follow-up question on the mobile money, maybe for Bilal or for Renee again. How does a single brand help with mobile money?
So let me maybe talk to this and hand over to Bilal on this side as well. Obviously, there is a very simple brand recognition perspective behind this. Even if you basically traverse in our footprint as a customer and you basically find an acceptance point that has the same brand, like in your home market, you will basically use the service. Second to this, there's obviously also a brand spend perspective behind this. It's way more efficient to build one brand across the footprint. That's what all of the online players do with their brands. And there's actually, for me, no economic reason to do this differently, right? The brand that we will use will have a certain connotation with Ooredoo, so we will leverage our existing brand strength also to be quite efficient in this context. Hope that gives you already a perspective. Maybe I hand over to Bilal for any additional comments.
So thank you, Rani. And I think what one of the most important variables, of course, is that we appeal to the entire base, not just to a specific segment of the market. And that's where a single brand serves our purpose. I think the second most important thing, again, is customer trust, which links to Rene's comment on also using your mother brand to endorse it. And then there are multiple options that can be pursued over time. So on one side, we are making sure that there is some sort of an endorsement. This is still work in progress on from the mother brand. On the other side, it's so important that this is ubiquitous across markets and appeals to multiple segments.
Great, thank you very much. We got another audio question here from Egypt, from Omar Maha.
Hi, Andreas, how are you? Hi, everyone, and thank you very much for the presentations and the insights. I have just a quick follow-up on mobile money again, and what Aziz mentioned regarding the portfolio rationalization exercise. I know you mentioned that you know, probably most of the, let's say, low-hanging fruits are already identified, and I think maybe what you're implying is that most of what is left, or you know, there isn't much left to be done. You also mentioned that it's an ongoing exercise whereby you could identify additional you know, initiatives in the future. So my question is, do you see yourself perhaps, you know, carving out the mobile money business sometime in the next few years if it grows to a big enough beast? And what sort of like critical mass do you think you know, this would require?
So in terms of portfolio rationalization, I think the two big plays, which were Indonesia and Myanmar, yes, have been executed. They're not, Myanmar is not closed yet, so there's still work to be done. TowerCo is also a lot of execution work. Data center is a lot of execution work. We are incubating the MFS platform with a view in the, I would say, medium run to spin it off or carve it out as an independent vertical, an independent business. What is the opportunity? As you've seen, you know, we currently operate in markets of roughly, if you just take the MENA region, we have 45 million subscriber base. What you've seen across general markets and, you know, established mobile financial services providers provided by telcos is usually an uptake anywhere between low teens to mid-20s% of the subscriber base, organic from one telco, and then cross over to other telcos. We believe there's quite a ramp up possible. Of course, when will we carve it out as a single business is when there's sufficient substance to it, and we believe that independent costs are rationalized.
Thank you, Aziza. How much time do you think this would take? No worries.
There's a big difference between how much time we would like it to take versus how much time it might take. I think a realistic timeline is somewhere between 18 to 24 months. We should have a very strong view on how successful that business is and how much value resides in it to be spun off or carved out as an independent business.
That's very clear. Thank you very much.
Excellent. On the people strategy, question for Fatima. What is Ooredoo doing to set themselves apart from competition for talent?
Thank you very much for the question. As you know, I've said in my presentation, of course, we live in a competitive world, not only on the customer side, but on the talent side as well. We're working very hard on making Ooredoo employer brand very attractive, creating that loyalty, investing in talent. We're building a full transformational HR plan that looks at all the business strategy and how can we tackle it from a people strategy perspective as well. We're focusing on key pillars of attracting and retaining the talent, investing heavily in learning and development, building Ooredoo Academy. This is a project building the foundation right now for that will inshallah that looks at standardization of learning and development, making sure we upskill and reskill our people in line with our strategic workforce planning to ensure we have the right people in the right time with the right post to deliver on the projects that we already commit to our shareholders. That's one element. Other is really elevating the employee experience. We, of course, over just a course of a year since 2020 to 2021, improved our OHI, Organizational Health Index, from being the second quartile to top quartile, with 4 OPCOs already being in top decile across the world. That's an amazing result in less than 12 months of execution. We're also putting plans to actually even push further and grow this OHI even further in 2022, and continue to look at employee engagement surveys and pulses to take the feedback from employees on looking at how can we improve their experiences and help them deliver the targets that they want to deliver in their careers. In addition, of course, we're going to continuously improve all elements of the working environment, being leading in future of work policies. How can we really adapt and be future forward looking in terms of providing to our employees?
Excellent. Thank you very much for the insights there on our people strategy and the organizational health index as well. Part of the organizational health is also having a regular lunch times, and we are coming to the lunch break now. We have one question here left, and I just read it out. Post the deconsolidation of Indosat and the sale of Myanmar assets, drop in CapEx spending, there's significant increase in cash flows available to distribute to equity holders. Any plans to come up with a multi-year dividend policy similar to a few regional peers? I'm not going to answer that question now, but in the afternoon, we're going to have our group CFO, Abdullah, talking about this. We're going to have the finance presentation starting at 1:30, and then we have OPCO presentations on Qatar, Iraq, and Indonesia. And we're going to have another Q&A session at 2:15. Thank you very much for joining us so far. Enjoy your lunch break, and we see you at 1:30.